Hello and welcome to another episode of the Of Interest podcast. My name is Dan Brunskill. Today we have a very special episode talking to Deputy Governor of the Reserve Bank, Christian Hawkesby, about the blockbuster monetary policy statement and whether or not it was a policy U-turn. Christian Hawkesby, thank you for coming on the podcast.
Good to be here.
It was a bit of a blockbuster monetary policy statement, bringing 3 years of tightening policy to an end. But I want to start with the hot button tabloid subject before we get into some more serious details. Some economists have called this a policy U-turn. Governor Adrian Orr says just saying that should disqualify them from being commentators. But it is true that in May the committee was contemplating a rate hike. Now, 3 months later, it's cut the official cash rate and looks set to keep doing so. If it's not a U-turn, how would you characterise it?
Just that a lot has happened over that period, and if we look back to May, we had a central projection that was pretty flat, maybe a slight upward bias if we were having to do anything very much in the near term, but one where in the record of the meeting we sort of laid out there's some big uncertainties here, either way, in terms of inflation being sticky and persistent on the upside, being the upside risk, and the downside risk being we've had tight policy for quite a while. The uncertainty was around the speed and intensity that would be felt in the economy. So since May we've had a whole heap of evidence on that downside part of the uncertainties playing out, and having a whole lot more evidence that monetary policy has sort of worked. My main bit of advice is I just think our record of the meeting that we put out is a really rich capture of the discussion in the room. So if you want to feel like you've been in the room and you've had to endure a week and a half of discussions and you can distill it down to a 5-minute read, I would encourage people to absorb that, to sort of give them a feel of those uncertainties that we navigate.
So would it be fair to say the reason you don't think of it as being a U-turn is while the track has moved quite a lot, the May statement outlined that was a possibility, that if the economy became weaker you might look to cut earlier. It's not what was shown in a central projection, but it was reflected in the record.
That's right, as part of the discussions of the uncertainty that laid ahead of us. Also, as we moved into, I think people forget the July monetary policy review, that's the light touch one that we do every 6 weeks in between. That clearly signalled that we'd shifted from that, we're on hold we're restricted for a prolonged period to, this restrictive stance isn't going to last forever. That was the message in July. I think the other thing we looked back at was, how far do our projections typically get revised? From round to round, and the answer is actually they get revised quite a fair way, and particularly through that tightening period. We were when we were doing those 50 and 75 basis point moves, our projections were moving really quickly with them too. The difference, I think, is how it feels when you're at the top or the bottom of the cycle, and so when you've been projecting things to go sideways and you're sort of at the top or the bottom of the cycle, it feels like a bigger deal when the projection moves direction. So it's quite similar to the feeling back in August 2021, where we'd had policy loose as we could, and we had intended to keep it there much longer, but the evidence just built up. It was time to tighten. The evidence is built up the other way now.
Is that quite often the way it goes with monetary policy? You kind of hold as long as you can until you see things turning sharply, and then that's your signal to react. Is that quite a normal way to do it?
It's a balancing act, because you can't, if you wait too long. This is why monetary policy makers just live with a knot in their stomach, because you can't wait until you've got the perfect amount of evidence and that everything neatly falls into place, because you know that things work with lags. And if we waited until we were absolutely certain about inflation, we've probably had our policy too tight, and we're going to create a cycle down the other side. So you you can't wait until you've got the perfect information set. You need to work with judgment. There will always be uncertainty there. It's just sort of how you weigh that up.
Yeah. you're confident you haven't gone too late? Because you could argue that you've waited, one meeting too long.
Yeah, well, it's a valid question to make. I think the other thing is that there is no sort of perfect answer, and we're trying to get things roughly in the right spot, and that's the big question you're asking. Really, is like, it's really is this 0.25% exactly the right number, or not exactly the right number? It's more like, are we roughly in the right space? And is there, where we've got to now is we've got a weight of evidence saying actually we need to move into a different zone now.
Yeah.
And we get to do it every 6 weeks. So, if you're 6 weeks late or 6 weeks too early, you've got that wriggle room to sort of adjust to information further as it arises.
It was interesting to hear your colleagues talk at Select Committee about the lag, and they suggested something which I've been thinking might be the case, which is that on the way down, the lag might be shorter than it was on the way up, because on the way up people are fixed into long-term mortgage rates and are slower to react, whereas here they're kind of ready for rates to come down and are positioned. Do you think that the lag on the way down is smaller than it was on the way up, potentially?
It's something that we're conscious of. We have noticed this shift. We've got a mortgage market where people, tend to fix some, 1 to 2 years, maybe 3, into floating, and that sort of shifts around through time, given the conditions. We have noticed a shift around half a year ago. Around 50% of mortgages had a year left in their maturity, or less than a year left. We're now rolling forward with the shorter fixing. It's more like 75% are in that sort of shorter zone. Got to be conscious that we're still talking in the context of there being a lot of uncertainty about how fast the transmission mechanism is. So typically we talk about 12 to 18 months from change in interest rate through to inflation. 3 to 6 months of that might be the first step from interest rates into activity. So, that's the sort of margins of error we're talking about. It's also just one of the many channels. That's the mortgage pricing channel, but business loans are typically at much shorter refixing cycles. You've got the asset price channel, you've got the exchange rate channel. All of those things, work their way through.
The asset price channel sometimes moves in advance, sort of time travel. Talking about the change between the May and the August decision, can you talk us through just what are the main factors that have changed? And it strikes me, reading through the monetary policy statement, which I did cover to cover this morning, which
well done.
Adrian will be very pleased to hear. He's always saying, read this document. So I'm like, got to go cover to cover. It seems like there are two main things that changed. Economic activity, or GDP, has ended up being quite a lot weaker than you forecast. And you also have new thoughts around how people in the economy and price setters are adapting to low inflation. It seems like they are accepting that low inflation is here and making decisions accordingly. Can you talk through, first of all, are those the two main things? And can you talk through why they have happened?
Yeah, well done. I think you've nailed it in terms of the two big developments and changes, and how we've learnt over that period as well, what we've learnt. On the pricing side, you go back to that May period, we still had headline inflation was at 4%. We only thought it was going to kind of get down to 3.6 in the next outturn, and even by the end of this year it was a 50-50 call whether it was going to be above or below 3%. And that's sort of the information set we had at the time. Pricing intention surveys were still very elevated. They were kind of one of the last things to start moving, which we had expected to move sooner. So we still were in that, and we'd gone through a period where domestic inflation hadn't really shifted despite the economic activity cooling, and that was sort of telling us something about, well, maybe this economy can't grow as fast as we thought it could. There was all of that was happening at the time. And on the activity front, it was a story about we know monetary policy is working because some of the things that would move first, some of the more interest rate sensitive parts of the economy have moved, but some of the other parts haven't really moved yet, and we're not sure whether that's because we're not tight enough or whether we are tight enough and we're just about to see it. So then you roll into July on the pricing side. We've had all those the pricing intentions have fallen, the expectations have fallen, and then the headline numbers have come in weaker as well, primarily because of the tradables inflation, but still we're talking about the next inflation outturn being in the order of 2.3%, so we're sort of well, if you take that as where we are now, we're sort of well within the band, and that's all of those things become kind of quite strongly reinforcing in terms of anchoring expectations and confidence that the domestic pressures will come out at the same time that all of these activity indicators have come in consistently weak. We've been asked about, well, what's this about talking a focus on these sort of second tier high frequency indicators? We've always looked at them. It's just that typically they're things that feed into our projections. They're quite volatile. This time around, they're all pointing in the same direction, which sort of gives us that confidence that actually that it's a strong signal here that activity is soft. And if we stick around and wait for the GDP outturn, well, that's so backward looking by that point, and we know that that's not necessarily the truth either, because there are lots of flaws and pitfalls with the way that we measure GDP and the like. So I think all of that sort of came together such that we do have a lot more confidence that we can shift into a different zone now from where we have been.
The day after the NPS, the household pricing expectation survey came out, and it was lower, but still above the 2% band. It was 3.1 or something like that. Does that worry you?
I haven't looked into the entrails of that yet. I mean, my impression was that it was, not materially different from the story that we're telling in terms of the, how those components feed into the broader CPI as and when it comes out.
It was definitely lower. It just was above the band. On GDP, back in May you were forecasting economic growth this calendar year. That's very much reversed. We're now expecting, a 0.4, 0.5% contraction this year instead. Do you consider that to be a forecasting error? Did you get that wrong?
Well, mechanically it's a revision of our projections, and that's just what happened. Every quarter we relook at what we've learned about the economy, how the starting points changed, how the global outlook's changed, how the our knowledge and assumptions about how the economy works and the relationships, all of that. So it has been a revision from where we were in May. It's part of that story about that uncertainty of how our restrictive we knew monetary policy was restrictive. We just didn't know for sure how much impact it was having on the economy and when that impact would come through. And so that's kind of what we've learned in the interim, and that will be one part of many factors that are keeping activity weak at the moment, and now we can factor that into where we go to from here.
So would it be fair to say that some of the difference between May and August is that in May you hadn't forecast such a deep recession in the quarter we're basically living through
That's
now?
Right. Yep.
And if you had, maybe you might have taken a slightly different stance.
That's right.
Yep. What else we want to talk about here? Yes, in inflation. 2.3% now, basically, today, assuming that's what the data comes out as. Is it fair to say we've achieved price stability?
We're in a much more comfortable position than we were in back in the days when headline inflation was up at 7% and we had the battle in front of us. So I think there is a sense of relief that we've got to this point. That's not to say that the battle is over, in the sense of some of this we're getting a bit of a dividend from fallen tradables prices, from overseas, and we know that the non-tradables, the domestic prices have got a way to go yet as well. But it certainly puts us in a different position and a different level of confidence that I just think people seeing the headline number with a 2 on it is going to have an effect in terms of the way that the sense of the environment that they're in going forward. I think also the spare capacity that we've got in the economy now means that even though that domestic inflation hasn't come down yet in the way it needs to, it's likely to, given the environment that we're in.
So your view would be that you do need to push down domestic inflation a little bit more, because we can't necessarily be sure that tradables will keep delivering us a 2% number.
And that's consistent with monetary policy still being restrictive.
Yeah.
We've lowered the OCR 25 basis points. That's from an area where we were confidently restrictive.
Yeah.
And now we start to remove some of that, but we still are in this environment where we need the cooling down.
Because if you ignore domestic inflation, you might say 2.3% is fine. That's well within the target band. You could cut to neutral. Is it the domestic inflation that's keeping you from?
It's that core. Yeah, it's that sense of core inflation that you got to strip out all the volatility and all the things that may just come and go to give you a sense of where is inflation likely to settle. In the future, and that's why we publish those core measures as well. They're all headed in the right direction. They're all heading lower, getting closer to 3, slightly above or slightly below 3% on that trend back to 2.
I do remember that period where there were a few quarters where the inflation number would go down, but then you would check the core inflation at 3 p.m. on the RBN website and it had barely moved.
That's right.
And that has definitely changed. You see it coming down consistently now. It's been very encouraging. One thing the Reserve Bank has always been very consistent on is saying that once it's confident inflation will get into the target band, it will begin to ease rates. You've reached that confidence. Can you help us understand what sort of confidence interval we're talking about? Do you feel like, I'm sure you don't put a number on it like this, but just illustratively, are we talking about a 90% chance, a 99% chance, a 51% chance? What sort of inflation staying within the target band, settling at 2%? You're obviously confident enough to cut. Can you try and put that in perspective for us? How confident?
Yeah, well, I think we had a bit of a comms challenge there, that there was this sort of misperception that we were going to keep the OCR at 5.5 until we saw headline inflation below 3.
Yeah.
But because monetary policy works with a lag, that'd kind of be too late. You need to work on the basis that your monetary policy is going to work, it is going to move in that direction. You don't have to wait until the numbers within the 1 to 3 band, but you just have to have that level of confidence that you're seeing what you need to see, such that it will settle in that band. There are still large confidence areas around that, or confidence bands. We've talked about on the inflation measure over a 12-month horizon, that it's 1 percentage point either way.
Okay.
So if you think you're at 2% and you're settled at 2%, over the course of the next 12 months, there's enough scope for shocks or noise that could push you out either side, and that's kind of why we focus on 2%. Aim for the middle of the dartboard, such that you've got the most chance of being on the dartboard. That's kind of the way we do it.
It feels like the risks that are talked about most are inflationary risks to do with deglobalization or climate change, or there's a very long list of things that feel like they are risks on the inflationary side. Does that make you tempted to aim a little bit below 2%, put a little bit more buffer on that side than this side?
No, I think that some of the thing, there's a distinction between inflation and inflation pressures and relative prices.
Yeah.
So there are some things, like the climate change and weather effects and the like. They might change relative prices, but are they going to? Or they might make prices more volatile. But will they, affect ongoing inflation of all goods and services? So that's something that we work through and just think: is this a relative price thing that we're talking about, or is it a general inflation pressure thing? I think the way we see it from here, things are balanced in terms of we see risks on both. We've got a central projection that is still above, the target, but it's coming down. Around that, we see risks either side. One is that inflation pressures ended up being more sticky than we're assuming. That they remain elevated. The domestic stuff is slower. People continue to be backward looking in terms of the inflation they've seen. They keep looking in the back mirror, and that that will slow the process down. So that's probably the biggest upside risk. Attached to changes in the global environment, geopolitical pressures, trade pressures, and things which change those global prices. Then on the downside, it's people worry about inflation when it's really high, but once it's low, that sort of rational inattention comes back, and they just take it for granted that things are going to be at 2, and that makes our life much easier, and it's all much faster to get back where we need to.
Bet you're looking forward to those days.
Long may they last.
We're running out of time, but my colleague David Hargreaves wrote a very interesting column this week which suggested that the OCR track, the projection, has been becoming a little bit of a distraction. People are hyper-fixated on it, and at times even ignoring the current OCR. You sort of say, here's our policy and here's what we might do with it, and people focus on the maybe bit.
Yeah.
What do you make of that? Do you think people are hyper-fixated on it? Do you think there is a better way to communicate that? What do you make of the OCR track?
I do think that it is over-analysed, and there's something quite peculiar that happens when someone sees a line on a chart or they see a number in a table. It has this sort of sense of being real and factual. When we know it's a projection, it's conditional, it has a whole lot of assumptions, and we talk about those sort of endlessly. So I think that is the downside of publishing a projection. Why do we do it? It's a storytelling device in terms of this is the most, given what we know and given what we understand at the moment, this is the central case of many. My advice to people would be to focus more on the record of the meeting than the OCR projection, and the reason for that is that you get all the richness that a short but perfectly formed essay can give you, which is the whole story about why is that track the shape it is, what are all the factors that we've considered that have fed into that, but also what are the uncertainties, because we don't publish a fan chart, and that's because we've got people fixated on a central track data. We want them fixated on a fan chart as well, or fixated on particular scenarios that we publish. But that's the benefit of having a record of the meeting, is that you can describe those things. And so I think that is your best guide for us going forward as a clue to what's going to drive the next step. It's what's in that record of the meeting.
Okay. So focus on the text of the record of the meeting, obsess less over the track, which might be changed from year to year.
Wonderful.
Brilliant. Christian, thank you so much for your time. I really appreciate it.
Good to chat. Thanks a lot.